Hello there. Welcome to the module on trial balance. In this module, we are going to learn the following. What is trial balance? The objectives of preparing trial balance, format of trial balance, some of the adjusting entries passed in the books at the beginning or end of an accounting period. We will also look at some of the common errors made by accountants in the books of accounts. So, what is a trial balance? A trial balance is a list of closing balances of all ledger accounts in the books. It's a source document for preparing financial statements such as profit and loss account, balance sheet, and statement of cash flows. A trial balance helps ensure accuracy of ledger entries by listing the closing balances of all accounts. Because of the double entry rule, the total of all accounts with debit balances should equal total of all accounts with credit balances. Some of the reasons why companies prepare trial balance are shown. Trial balance helps check arithmetical accuracy of entries posted in the books. If the total of debits and credits of the trial balance do not tally, there are one or more entries made in the books. Once you find that the trial balance does not tally, you will be forced to identify and rectify the errors till such time the debits are equal to the credits. As I explained earlier, trial balance is the first step towards preparing the financial statements of a business. Trial balance also acts as a summarized ledger. By looking at the trial balances, you will know the total sales and expenses incurred for a period and the closing balances of assets and liabilities as of a particular date. What you see on your screen is the pro forma of a trial balance. Trial balance is prepared as on a particular date, which is typically the last date of an accounting period. The names of the accounts and their closing balances are reported in the trial balance. The closing balances are shown either on debit or credit side depending on the type of account. When preparing trial balance, you have to transfer closing balances from the various ledger accounts to the trial balance. While doing so, try to remember the following rules. 1. Asset accounts have debit closing balance. 2. Liability accounts will always have a credit closing balance. 3. Expenses and losses related accounts should always have debit closing balance. 4. Income and gain related accounts will have credit closing balance. 5. Capital account will always have a credit balance. If you find that you are getting a different type of balance, for example, the closing balance of an asset account is say a credit balance, please double check the entries before transferring the balance to the trial balance. Otherwise, there is a very high possibility that your trial balance might not tally. Let us now try to prepare a trial balance for the example that you see on your screen. We have to prepare a trial balance for the closing balances of Alpha Limited as of 31st December 2012. Before we prepare the trial balance, let's analyze the accounts listed. Cash is an asset account and should therefore have a debit balance. Salaries account is an expense account which should also have a debit balance. Capital account, as we know, will always have a credit balance. Debtors account is an asset and should therefore have a debit balance. Creditors account is a liability and will have a credit balance. Building account is an asset which will have a debit balance. Rent account is an expense and will therefore have a debit balance. Furniture is an asset and will have a debit closing balance. Sales, on the other hand, is an income account and will have a credit balance. So once you plug in the accounts and their closing balances into the trial balance format, this is what your trial balance should look like. As you can see, the total on the debit side is Rs 10,000 and it exactly matches the total on the credit side. To prepare trial balance, apart from the regular transactions that happen in an accounting period, there are three main adjusting entries that are passed in the books at the beginning and end of every accounting period. So the first is what is known as opening journal entries. These entries are recorded to carry forward the closing balances of assets, liabilities and capital from the previous year to the current year. Assets like buildings account or land account or machinery account have useful life of several years and hence their account balances need to be carried forward year after year. Similarly, liabilities have to be carried forward till they are fully paid off by the organization. Similar to opening journal entries, closing journal entries are also passed at the end of every accounting period. To transfer revenue and expense accounts to trading and profit and loss account, we have to prepare the closing entries at the end of accounting period. We also need to close the balance of assets, liabilities and capital in order to carry them forward to the next period. The third category of accounting entries are known as transferring entries. These entries are required to transfer the closing balance of certain accounts to other accounts. For example, the balance in the drawings account has to be transferred to the capital account at the end of every accounting period.